And that is where the fund of fund structures kind of benefit. If the fund of fund, if the underlying funds are being set up or in some geography where there is, again, they do not have tax on churn as well as tax, the dividend taxes and all of those, then it becomes a very efficient mechanism.
All in all, it seems like fund of fund structure is the most tax efficient model. But Nirmal, as it includes multiple layers into it, does it make the structure cost heavy?
So the answer to that is one will need to do a due diligence on a structural on each of the structures. So when someone is doing looking at a fund of fund, please look at the total expense ratio, including the that of the underlying fund. Also look at whether this fund charges a entry load, exit load, etc., and whether there is such a charge at the underlying fund level, because all of this will is going to impact your returns. If it is a passive fund of fund, as a fund of fund which is investing in passive strategies, then ideally the expense ratio at the underlying fund level will definitely be low, but the expense ratios at the parent fund level should also be low. And if it is a active fund, then the expense ratios should will accordingly have to be reflected. As in, you have active funds in India which charge anywhere from 0.6 to whatever up to 2% or something. You will have to look at similar expense ratios are there. Today's topic that we are discussing is India's gateway to the world, navigating the GIFT City ecosystem. So, GIFT City, as you all would know, stands for Gujarat International Finance Tech City. It is physically located in India between Ahmedabad and Gandhinagar, but from a FEMA perspective, it is not a part of India. It is a foreign jurisdiction. Not just that, but it also has a regulator of its own, the IFSCA, the International Financial Services Center Authority, which has all the powers of RBI, SEBI, PFRDA, and IRDA in India. So it has a unique identity of its own, and it is a complete financial ecosystem. So it has a complete banking system. It has exchanges of its own. There are brokers, global access providers, fund management entities, and not just this, some unique businesses like aircraft leasing and ship leasing, which you wouldn't otherwise find in India. And then there are a host of fintech companies, technology companies as well. So in short, it is a multifaceted IFSC. What we would be focusing on today is not looking at the entire ecosystem, but the small part of fund management entities and how investors like you and me can use GIFT City as a platform for our investment needs. So before we get into that, and before we make a decision to take a long-term bet on products in GIFT City, we need to first assess whether GIFT City has reached a stage where we can take a long-term bet on GIFT City itself. And so why don't you, Akshay, take us through what makes a successful international financial center, and how does GIFT City fit in amongst that?
So in last 3 decades, many countries have tried to set up international finance centers and tried to make it successful. But the list of the IFCs which got stalled or which has zero progress now is much longer than the list of successful IFCs. So we have tried to plot 6 different characteristics which decides whether IFC will be successful or will get stalled. So the blue ones are the prerequisites. These are the characteristics which IFC must have at the stage of setting up itself, and the gray ones are the parameters which develops over time. Now the first one is really important, which is institutional quality. From a financial industry standpoint, investor must have that confidence that their funds are not arbitrarily stalled or frozen in IFCs, or the rules are not changing retroactively, or regulators are not behaving politically, rather they are behaving politically, professionally. The second one is the reputational alignment, and it's very important to align your regulations with the globally accepted standards like FATF, CFT compliances, AML, CFT compliances, uh, or tax transparency, etc. And the third one is the accessibility. Now, finance is all about free flow of capital. So IFC uh, uh, must be able to have the system in place where forex conversion is quite easy. The repatriation of currency or the currency movement is quite uh, easy, and that's why it's kind of an important parameter to have at the setting up stage itself. The other ones are generally develop over the time when IFC progresses. So it must have three kind of pools: the capital pool, including domestic capital as well as the foreign capital. It must have the good talent pool. It must also have the good intermediaries, pool of intermediaries like exchanges, brokers, regulators, etc. The fifth one is the credible legal architecture. Now, a lot of these successful IFCs have a common English law in place, or the arbitration is quite similar to the global standards. But the countries where that local regulations are not very much aligned with global standards actually create a carve out. So Dubai has DIFC, so India has thing like GIFT City, and the last one is the strategic specialization. This is something which a lot of the successful IFCs even create after having a good vintage of at least 5 to 10 years. Now we'll look at the list of the IFCs which got stalled or progressing really slow, and all of these IFCs are mostly missing the two major parameters, which is institutional quality and reputational alignment. And if we see the same parameters for the successful IFCs, I think they got the green tick marks in on all the parameters. Now here the GIFT IFSC is really an interesting case study because it gets the green tick mark in all the prerequisites. The capital and talent pool or legal architecture is quite developing. So India has a good pool of capital and talent in the domestic markets, and it's just the matter of time it will flow in the GIFT City as well. The IFSCA, which is the authority for GIFT IFSC, is aligning their policies to the global standards, and they are also setting up the international arbitration, which will again help to make it align with other IFCs. And specialization is something which is a far-fetched thing. It will, I mean, the GIFT IFSC will figure out after some time in what area it want to specialize into. Otherwise, it already offers all the offerings which all other IFCs or successful IFCs are offering. So here we have plotted the GFCI ranking of various relevant IFCs. So GFCI ranking is Global Finance Center Index. This is so it's the lower the better. So if we see the age-old IFCs like Hong Kong and Singapore, they are ranging somewhere between 3 to 5, whereas Dubai is quite comparably new and it is still evolving. It has moved up from 17 in 2020 to 7. But if we see the GIFT City, it has climbed the ladder very quickly. It got debuted in March 21 with the 92 rank, and it has surpassed Mumbai now in March 26 because of free flow of capital and many other parameters.
Not just the rankings, but this is also visible when you look at the kind of assets and the kind of turnovers that GIFT City is now accumulating. So the banking assets in GIFT City about 5 years back was hardly anything. It was negligible. At present, it stands at 106 billion US dollars. Now, this number, to put it in context, the total assets of Indian banking system stands at around $3.5 trillion. So that's quite significant a number coming from one small geography within India. That also can be seen when you look at the capital market flows. The average monthly turnover of the exchanges in IFSC that has been growing at a very healthy pace. Initially, this bulk of this came in when the Singapore Nifty was shifted to GIFT Nifty. A lot of volumes came in from that, but now there is a lot of organic growth also that is coming in. Similarly, for the funds and the fund management entities, there are about 200 plus fund management entities in GIFT City at present, and the initial bulk definitely came in from funds moving from other offshore jurisdiction to GIFT City, and that is where you see a significantly large number, $32 billion in commitments and $17 billion in investments. But of late, again, organic growth has picked up even in this segment. And when you look at the retail fund numbers, these are the newest products that are available from GIFT City, and those the first retail fund, it has not even crossed 1 year so far, but this have started accumulating significant volumes there on a month-on-month basis. So yeah, so having set a context of that, GIFT City has definitely crossed a certain hurdle where we can now say that it has not been stalled, and it is progressing well, and it has all the basic parameters that are required for the uh, success of any IFSC. We'll look into what all products can be done out of from a fund management perspective. Again, what all products can be done out of GIFT City, and if you so if you think of who all can invest in through GIFT City, they would be either resident Indians or non-resident Indians, and foreign individuals or foreign institutions, as the case may be. And the investments can happen either in Indian markets or in global markets. So that creates a 2 by 2 matrix. Now, for resident Indians to invest in India, they don't need GIFT City per se, and there's no use case there. So that is marked out as red. But for resident Indians to invest in global markets, there is a segment of product which is called outbound products. Now, why are these outbound products required, and why is there a case for Indian individuals to invest, Indian individuals as well as non-individuals to invest in GIFT City? So, actually, why don't you take us through why global diversification in the first place is required? Yes.
So there are actually two important cases for a global diversification. First is the access, and second is the diversifying risk. Now we'll cover this one by one. So we have been hearing a lot about India's market cap share versus the global market share. It is less than 5%, but that itself does not make a case that we should globally diversify our portfolio. It's very much beyond that. So the global investing actually opens up a large pool of high ROIC businesses, or the companies which create a sustainable cash flows or capital efficient companies, and with a good value investing opportunities. Now, that doesn't mean that the opportunities are lacking in India, but it's just that the funnel becomes very large when we are thinking about the global investment. Now, historically, we have seen that the many transformative and innovative themes have actually played out outside of India, and India has been great in terms of providing services uh, or following up the innovative trends. But the lot of value capture already would have happened at the forefront of the transformative leg, or at the companies which are at the forefront of this transformative leg. And these kind of opportunities are generally missing in India. So even if we look at the cloud companies like Google Cloud, AWS, Microsoft, these are the hyperscalers which are based in US, and we can't find any similar kind of opportunity in India. Then we have companies like TSMC, Nvidia, ASML, and these companies have created a kind of a monopoly in their respective niche. So through global investing, actually we get chance to invest in these kind of themes. And if you look at various FMCG reports and India consumption story, you would find that a lot of the local consumption is moving towards a premiumization, and uh, towards the premiumization, and maybe it could be because of various factors like increasing income levels or change in demands. But these are the companies which are benefiting more out of this shift in demands. And so there are companies like Boeing or Lockheed Martin. These are the companies which are based outside of India but benefiting more from increasing travel spends. Uh, so so when we are already spending a lot in these kind of companies, why not to benefit from investing in these companies as well?
Just to extend that point, when we say premiumization, it also the ultimate leg of premiumization is luxury consumption. And luxury companies, after what they've seen, the kind of growth that they've seen in China and now the Chinese growth stalling, some of those companies are also looking at India as the next big growth market. Michael Kors, for example, has uh, expanded significantly in India. There are a lot of these other companies which are looking at India as a big market, and we are spending there. But to benefit out of their those companies growing in India, we need to be expanding, investing in those companies in their home jurisdiction, which would typically be somewhere in Europe or other developed markets.
So we have covered the first part of the case for global diversification, and which is the access. Now, while investing in outside India, one has to remain mindful about where they are investing. The material chunk of investment should not go towards exotic themes or the smaller markets. The ultimate goal is to achieve the risk-adjusted returns, and for that, we must actually diversify the risk rather than amplify the same. Uh, so there are many country specific events which impacts the local markets, events like demonetization or GST rollouts which happen in India, or there are some political events or natural calamities event which only affects the country specific returns. The other part of the geography is mostly not impacted by it. So diversifying a portion of your investments in the global markets will actually insulate your portfolio to that extent from these kind of risk. And we have seen a history of rupee depreciation versus dollar. So diversifying in the global markets also helps in kind of it provides kind of a natural hedge and helps in the wealth preservation. But when we are based in India and we are uh, trying to invest in other geographies, we must blend our investments with the markets which are uncorrelated uh, uh, with our market to often lower the volatility. So statistically, any correlation below zero point 0.7 is considered to be a loose correlation, and the loose correlation here means the good diversification. So we have tried to plot a 3-year rolling correlation between NSE 500 and MSCI World, and we have seen that 80% of the times this correlation has been below zero point 0.7, and that means it's a good diversification. Now, the points where the correlation was more than zero point 0.7 are the times where uh, there were any major global events happening out there or recoveries coming in after those major global events.
Yeah. So if you look at those two events, basically the where the dots are above the line, that is the 2008 GI global financial crisis and the recovery after that, as well as the COVID period and the recovery after that person. And then in addition to this, obviously as we have seen over the since independence, India's currency has been depreciating over a period of time, and that 3 to 4% kind of CAGR depreciation, that is something that Indian investors stand to gain additionally if that continues in future as well.
There are 4 common routes which Indians generally use to take the global exposure. Now, one would argue that investing in the companies which are drawing a lot of its revenue from the foreign markets can also be a good global diversification, right? But to some extent, it's true, but it doesn't solve for the two parameters which we discussed earlier: the access to the innovative themes and the diversification of the risk. So this particular method may still expose towards those risks. The second option is the domestic mutual funds. So we have a lot of international index-based fund of fund structures. Then we have thematic technology or certain thematic kind of funds which are launched by various mutual funds, and there are hybrid funds, which is a mix of domestic investments as well as the foreign investments. The third option is the direct exposure through brokers. Now there are two different categories of broker. First is the India-based brokers, which act as a sub broker to the foreign broker, and accessing the foreign markets directly through the foreign brokers. And last one is the GIFT City based options, where we have entire suite of options like PMS, AIFs, and retail funds. Now, just to compare all these options on various parameters, so the access to the larger pool of highly efficient companies and transformative themes is quite limited in the domestic mutual fund now, because of the RBI's restriction of $7 billion on the entire mutual fund industry. They cannot further invest in the global market. So the exposure here is quite limited, whereas it is still available in the direct exposure as direct option as well as the GIFT City based option. Similarly, so a lot of these countries in globally have the concept called inheritance tax or estate tax. So any foreign investors has to pay estate tax when they transfer the holding to their legal heirs. So in the mutual fund route as well as the GIFT City based fund routes, as the investments are made through a investment vehicle, the burden of inheritance tax does not apply. Whereas for the direct option, it is, the investor has to pay the estate tax on it, if applicable. The last one is the validity for non-individual. So there are two major routes for investing in the market. One is the LRS and OPI is generally used by the non-individuals. So that particular route is only available with the GIFT City based funds.
As Akshay discussed on the LRS and the OPI route, before we get into discussion of each of the products available in GIFT City, we'll just expand a bit on this. So the liberalized remittance scheme, or the LRS, is a route. So effectively, when you're transferring money to foreign jurisdiction, or even to GIFT City, since it is considered a foreign jurisdiction, you cannot do it through RTGS or NEFT or any such mechanism that you would normally apply in India. So it has to follow a proper window provided by the RBI, and there are two of these windows. For resident Indian individuals, it is the liberalized remittance scheme, under which RBI allows residents to transfer up to $250,000 in a particular financial year, and this limit is applicable across whatever spends that you intend to do in travel, education, or healthcare, and also for all the investment needs that you would have during the financial year. So GIFT City products, investment in GIFT City products is also through the LRS route, and LRS has so there's a TCS that is applicable on LRS if the amount exceeds 10 lakh rupees in a year, and that TCS rate is defined by what purpose code you are transferring money for. So when you are doing a liberalized, you are doing a transfer through LRS, you have to specify what purpose the fund is being used for, and that purpose code defines whether the TCS would be 2% or 20%. For investment related needs, usually the TCS is 20%. Now, this route is available only for resident Indian individuals. Non-individuals cannot be taking a LRS route. So for them, there's another route called the overseas portfolio investment. Now, overseas portfolio investment was always available for listed companies in India, for them to take exposure to global securities. However, it was not available for unlisted companies or corporates or any other type of entities. What GIFT City allows you is, if you have if you are investing in a pooled vehicle in GIFT City, then even unlisted corporates, LLPs, and registered partnership firms can also invest through the OPI route, and OPI allows you a maximum of 50% of your net worth to be invested outside India through at any point in time. Again, there's the benefit of there being no TCS in this. Now, there's one category which is very prominent in India, which is HUFs, and none of this covers HUF if you see. So that is because HUF as a concept is there only in India, and it doesn't get covered under the FEMA regulations, and hence it is not possible for a HUF to transfer money to either to GIFT City or to any foreign jurisdiction for investment through any of these mechanisms. So when Akshay discussed about the $7 billion RBI limit for mutual fund investments in India, and that limit got over somewhere in February 2022. So one would have uh, ideally posed that the only mechanism for anyone to take global exposure was through LRS, and one would have assumed that LRS towards investment use case would have should have increased significantly. But at this juncture, let me do a show of hands here. So, how many people in this room had actually done a LRS for investment purpose to some to through a mechanism other than GIFT City? So I can count 1, 2, 3, 4, 5, about 5, 6 hands in about 100 odd uh, size, and that is pretty much how the data also looks on the ground. So if you look at LRS for investment purposes, that number has grown, but that growth is also in line again with the LRS growth itself. So uh, it has LRS in investments have remained around 4 to 6% of the total LRS, the rest of the amount going into travel and healthcare and education primarily. Uh, this year, you can see that there is a significant jump, and a large part of it is because of the GIFT City products coming in a big way. So effectively, this is not counterintuitive. It is very much in line with what anyone would do. The complexity that was associated with doing a LRS investment outside of outside India was so significant that everyone, despite not, as in people who are investing only through mutual funds and not doing a lot of DIY investment, would prefer to remain invested in India rather than trying all these exotic things. And that is exactly what GIFT City is solving for. And yeah, so this is just the representation of LRS investments in a different manner. So if you look at LRS investments versus the gross equity inflows into mutual funds, we are not even considering the direct money flows that are coming into share markets. But this number has remained in very low single digits. It is less than 3% across the period. So if you put together this number together with the $7 billion mutual fund limits, the total diversification that Indians have is significantly low as compared to what one would normally desire. So we have been early proponents of global diversification since the GFC days, and we have Parag sir has always maintained that one should have 25 to 30% kind of a portfolio outside India, something that was doable earlier. But now with GIFT City, that is actually again possible in a much simpler manner. And so, Akshay, why don't you take us through what products are available in GIFT City, and how can one look at uh, again growing their global exposure?
There are four common product structures which are available in GIFT City for the outbound investments. Uh, so there are gift-based exchanges which offer the depository receipts of the foreign stock. Now, resident individuals can directly own the stocks in their account. The benefit of these DRs are the gift exchanges offer it in a very smaller denominations. So let's say Apple, which is currently trading at $300, they would have this DR somewhere around $10 to $12. So it's that small. Uh, but the only challenge is the NSE exchange, which is currently operating in GIFT City, only has the universe of 50 stocks, and the volumes are also very negligible, and the ecosystem is also not that mature where you can actively make the investments. The second one is the outbound PMS. Now, the outbound PMS is very much similar to the domestic PMS itself. You'll get the direct holding of stocks in your account. You'll have all the transparency and customization of options available. But these investment has to be done through LRS. The minimum ticket size is $75,000, which is stipulated by the regulators, which is quite high as compared to the retail versions. Uh, but the challenge here is the estate tax. So investors who are investing in PMS may still be exposed to the estate tax, and they'll have to make the tax calculations or their tax compliance burden on their own. But if we see the outbound AIFs, so that problem is not here. The taxation is applicable at the fund level itself. So all the tax calculations and payment are done by the fund itself. Investor don't have to worry with all those compliances. Also, it solves for the estate tax problem. So all the investments are made at the fund level itself. So estate tax is also not applicable. But the bigger advantage is it is also available for the resident non-individuals. So OPI route is only allowed in the outbound AIFs or the retail funds which are there in GIFT City. But the problems with the AIF is the ticket size is very high. It's $150,000. The maximum investors are capped at 1,000 investors. There are very complex fee structures. The fee structures may include exit loads, entry loads, performance fees, etc. And the transparency of the expense ratio is also quite complex. It has complicated and lengthy onboarding process, as every investment is subject to the tripartite agreement with the investors, and many of these AIFs also have lock-in applicable. Now, all the problems which we have seen in other three options are getting solved here in the outbound retail fund. So, along with the common benefits, right, like OPI route is allowed, the ticket size here is quite low. There is no restrictions on maximum number of investor. Estate tax is not applicable, but the bigger advantage is the simpler onboarding. It's just a 1 or 2 days of process where you can actually onboard an investor and investor can start investing.
Basically, the idea for retail funds is to this is more like a copy of the mutual funds with some differences in taxation. And over a period of time, while the ecosystem itself is evolving, the onboarding should actually come close to what you would have in India for a mutual fund onboarding, and the transaction level as well as all the other reports and everything that you see would come closer to what is there in a mutual fund over a period of time. Just to summarize these 4 options, now we have not listed down those 4 options separately, but we have listed it in a different manner, and that is from a tax and structural point of view. So if you're doing a investment on your own through opening a account with one of the global access providers or some international broker or something, or if you're investing through a PMS, you are getting direct exposure to stocks. So that has a certain kind of taxation implication. The second route that one can take is there can be direct investing, either a AIF or a retail fund, which can be investing directly into global securities. And the third option would be where AIF or a retail fund would be investing in some underlying fund outside India, and that fund would be holding the underlying securities and doing all the churn as well as receiving all the dividends and all. Now, each of this, there are certain things to consider. Taxation, obviously, for PMS and DIY is at the investor level. For rest of the two cases, it is at a fund level. So long-term capital gains remains the same across all the three, at 12.5% plus surcharges. But what is important to note from an Indian investor point of view is when you're looking at global securities, the horizon for long term doesn't remain 1 year. It moves to 24 months. So anything below long term, below 24 months is considered short term, and it is not taxed at your 20% tax rate that is there in India. It was in the case of PMS or DIY journey, it will be taxed at the investor's respective tax slabs. But in the case of a fund structure, be it a direct investing one or a fund of fund, it is taxed at the maximum marginal rate, which is 42.74% at present. So effectively, the idea for anyone looking at global investing should be to minimize churn and ensure that you're looking at long-term holdings only, and look at products which would also fit in with this mandate. So when you look at this churn on taxation on churn, as well as the dividend tax, PMS would not solve for it unless it is a long-term oriented PMS. A direct investing structure would definitely be at some disadvantage over a long period of time, because when you look at when you compare it with a mutual fund structure in India, mutual funds are not supposed to pay taxes whenever they are selling any securities or whenever they are receiving any dividends, and that helps in long-term compounding. But if every time you do a transaction and you end up paying either 42% or 15% to the government, that will impact your long-term compounding. And that is where the fund of fund structures kind of benefit. If the fund of fund, if the underlying funds are being set up or in some geography where there is, again, they do not have tax on churn as well as the dividend taxes and all of those, then it becomes a very efficient mechanism, because the only time there will be churn in the portfolio or someone is when the investors themselves are exiting. In terms of estate tax, PMS and DIY investors, if they are investing in US, they'll be exposed to estate tax. But fund structures do protect against that. And then for non-individual investors, there's the direct investing, as well as basically it is the fund structure through which they can invest. So the PMS cannot. While see PMS, typically, if you see, there are a lot of negatives in this, but that has a very useful use case which may or may not be fulfilled by the fund structure. So if you there are a data point about 42 of the top MNCs have issued what about 1.2 lakh people. Yeah. So 42 of the top MNCs in the world have issued ESOPs to about 1.2 lakh individuals in India. That's quite a significant number. And this ESOPs, if you're looking at global diversification and also diversifying from one security to multiple securities, that without bringing that money to India effectively, that can be very well managed through a PMS structure. But in the fund structure, there will be there might be some complications in bringing that money to. In the fund, you will only accept cash, while in the PMS, securities can be accepted.
All in all, it seems like fund of fund structure is the most tax efficient model. But Nirmal, as it includes multiple layers into it, does it make the structure cost heavy?
So the answer to that is one will need to do a due diligence on a structural on each of the structures. So when someone is doing looking at a fund of fund, please look at the total expense ratio, including that of the underlying fund. Also look at whether this fund charges a entry load, exit load, etc. and whether there is such a charge at the underlying fund level, because all of this will is going to impact your returns. If it is a passive fund of fund, as a fund of fund which is investing in passive strategies, then uh, ideally the expense ratio at the uh, underlying fund level will definitely be low, but the expense ratios at the parent fund level should also be low. And if it is a active fund, then the expense ratios should will accordingly have to be reflected. As in, you have active funds in India which charge anywhere from 0.6 to whatever up to 2% or something. You will have to look at similar expense ratios are there. But the most important thing is, unlike SEBI, where you have a well-defined TER that is given, IFSCA, the regulations are, uh, I mean, it is evolving at present, and you may have a fee structure which involves management fees, other expenses, and everything laid out separately. When you're looking at this funds, combine everything and see what the total expense comes to, and not just the management fees or the expense ratio at the fund level, envelope level.
Seems like fund of fund structure is the most tax efficient structure, and it can also be the cost efficient structure as well. So we have covered the first part of it, and the first part of it, which is the outbound products, the options available for Indian investors to invest outside of India. But for the NRIs and foreign investors, why part is well known. I mean, investment in India will help them to invest in the emerging market, which is well diversified, which has a good track record of uh, uh, good returns over the long period of time, and good track record of corporate governance as well. Uh, so,
Plus the
Nirmal, why don't
demographics.
yeah, plus the demographics. So, Nirmal, why don't you cover the various options which are available in the GIFT City, or how GIFT IFSC fits in the framework there?
When we look at NRIs or foreign investors looking to invest in India through GIFT City, basically those category of products are called the inbound products. Now, when you look at inbound products, they can be either a PMS or a AIF or a retail fund, which is set up in GIFT City, and those can be either investing directly in India or can be a feeder structure. So when you look at PMS as such, a PMS in GIFT City operates in similar manner as in India. That is what we discussed. So effectively, it will provide direct ownership of stocks to the PMS investors, and then it there's no use case per se for global investors to look at investing in a gift based PMS which is investing in India, because uh, it loses all meaning of GIFT City coming in between. But if you look at the other two structures, whether irrespective of a fund structure which is doing direct investing in India, or a fund structure which is feeding into Indian mutual funds, both of those have quite a few benefits. So first of all, there's a lot of ease of compliance when a fund structure comes in from a GIFT City perspective. There's no requirement for a person to have PAN. If they have a PAN, then they'll have to disclose that. But if they don't have a PAN, they don't need to apply for a PAN and get one. Secondly, there's no requirement of tax filing in India for this funds. There would be no tax payments that will happen in India again for investing in this funds, and repatriation and all those will not be such a significant challenge, because you are investing in dollars, and that NAV is also declared in dollars. Ultimately, you'll get your money back in dollars. It's your money is while the fund will actually bring that money to India, but there's no repatriation risk that the investor is taking. The direct investment route in this case, which quite a few AIFs offer, there would be that challenge of taxation at the fund level. So anything that the fund receives as dividend will be taxed at the rate of, I think, around 35% or so. All long-term capital gains will be taxed at 12.5% beyond 1 year, and less than 1 year, whatever the capital gains are, would be charged at the short-term tax rate of 20%. Now, in this case, it is similar to what it is in India. The most efficient mechanism, though, for any investor to look at would be looking at feeder funds which are investing in Indian mutual funds, because there is a special carve out for that, for NRIs and foreign investors, that in such a fund structure, the mutual funds are not charging any taxes in India, and the GIFT City feeder fund also becomes a tax-free entity. So, from the investor's perspective, there is no tax to be paid in India or GIFT City, and if they are supposed to pay any capital gains in their home jurisdiction, that is it. Otherwise, it becomes completely tax-free, and all the other benefits remain the same as direct investing funds.
We have covered the two boxes in the matrix, which is the inbound products and the outbound products. But the bottom left corner of this particular matrix is quite interesting. So, Nirmal, please cover this particular.
As as you said, that it's very interesting. It's very interesting from a point that we looked at all the successful IFSCs right at the beginning. And when you look at all of those, none of those were built on the back of and became such large on the back of trying to bring capital into a particular country or trying to take out capital from a particular country. Most of them have become large because fund managers have come in there, have set up their shops, and are managing global money, which is being invested in global markets, which are without touching their home jurisdiction. And this is what will also define the ultimate success for GIFT City over a very long period of time. The underlying requirement again here for this to happen, as we discussed in the first slide, is trust. But when we talk of trust in this case, it's a different kind of trust. When Indians are looking to invest outside through GIFT City based products, or when foreigners and non-resident Indians specifically are looking to invest in India through GIFT City, the trust is that GIFT City is an extension of India, and so everything remains pretty much same. But when a foreigner is looking to put in money in some GIFT City fund which is going to invest outside, they are not looking at GIFT City as a extension of India. They want to see GIFT City as a standalone, independent jurisdiction, which will not have which will not have influences from any other party, and hence there would be a certain level of investor protection and everything. Now, GIFT has such things, but this is a very large segment and it is emerging right now. What are the options if someone, if a NRI or a foreign investor is looking to invest in global funds out of GIFT City? So the first option is there are already funds which are launched for resident Indians, and some of these funds allow for commingling of investments from NRIs or foreign investors with resident Indians. Now, the challenge with this structure is primarily the money will be coming from resident Indians only, and so it will be exposed to the kind of taxation that we saw for outbound funds. Now, a non-resident Indian who is investing outside India through a fund structure in GIFT should not be exposed to such taxation, but there is no way out. So there will be leakages and that will impact their long-term compounding. More importantly, if they are supposed to be paying taxes in their home jurisdiction, then the fund level taxation will not effectively protect them may not effectively protect them from the liabilities in their home jurisdiction. The second product, and this is very interesting because again, it is the investors are directly owning securities and not there's no structure that comes in between, but the PMS manager can be sitting in GIFT City as the PMS here again, because there is no relation that comes from the investors and or from the investments end to India, except for that the fund manager is in GIFT City, or the PMS manager is in GIFT City. So there is no taxation at India level or GIFT City level, and the investors would be looking at whatever taxes they are supposed to be paying in their home jurisdiction only. And then there's a third category of funds which will evolve over a point of time, which would be standalone, meant for global investing only, and will take money from global investors only. When such funds come in, there would be they'll be able to get uh, tax, as in they'll be able to shield their taxation from India under Section 9A of the Income Tax Act and all. But right now, there are hardly any options, and this is something that will evolve over a period of time. And so, having discussed what are the products available, it would and what are the benefits for various kinds of investors for looking at various GIFT City products. We will also want to discuss a few challenges and how IFSC is looking at solving some of those. One is, if you look at the challenges, probably you can classify it in two levels. One is at the onboarding stage and at the funding stage. Now, at the onboarding stage, at present, there is no KRA access for GIFT City. A KRA regulation has been passed by IFSC, and that will be set up in near future. But till that time, there will be, until the time a database of investors is built up, there will be uh, when an individual comes in for investing in a fund, there would be separate onboarding that they'll have to do with each and every AMC or FME that is out there. Secondly, for investors, digital onboarding is possible because of the link, Aadhaar based KYC process. But again, since there is no KRA access, it is dependent on CKYC, and journey may not be as smooth as mutual funds at present. For NRIs and foreign nationals, there are the onboarding process at present is slightly complicated, uh, and it requires notarization or in IPV, in-person verification, and all of those things. There is a VSIP regulation that IFSCA came up with, which this was, I think, in the month of November last year, and with those VSIP regulations, some niggles are being ironed out, and with that, it would be possible at least for NRIs to be onboarded seamlessly through digital platforms and all. And when it comes to funding, again, for resident Indians, the process involves either visiting the bank or doing it through your uh, net banking, and it is more complex than doing a NEFT or a RTGS transaction for sure. There are also high forex transaction charges and all. So some of the FMEs are actually trying to solve it at their level, and there are also a few PSPs who are helping out in this entire process of uh, funding. So that is getting solved for investors who are bringing in, for foreign investors and NRIs bringing in money from outside. Again, there's they face a similar challenge around the process being complex and all. Again, PSPs are coming in there. One unique thing that needs to be addressed is that gift as a separate jurisdiction is not being recognized by a lot of countries. So, for example, if you were to transfer money from, let's say, uh, US, some most US banks would to India, most US banks would ask for a IFSC code. That is a compulsory requirement, and they will also ask you for a purpose code, because that is again a compulsory requirement from the RBI side. Now, when you're transferring money to GIFT City, as such, there is no RBI, and there's no this branches are outside of India, so they don't have a IFSC code in the first place. But the US banks will not recognize do not recognize that at present. So some of these challenges are being ironed out over a period of time. And obviously, what made mutual funds so good at and made them grow significantly was SIPs. So at present, there is no mechanism of having an automated SIP in GIFT City. Again, some things are being tried out, and over a period of time, this SIPs will also come by. I think that is what we had, and we would like to take questions if any.
A resident Indian is investing through GIFT City directly in a through a PMS, and the inheritors are not in US but they are in India. Is the estate tax still applicable and how?
So when you look at estate tax, each country has a different kind of estate tax, and primarily your question was pertaining to US. So in US, there's estate tax which is applicable to the residents there, and the limit for that is very high. I think it's some 30 million or something. And there's also a estate tax which is applicable to non-resident aliens, as they call it. Uh, if the total assets of those NRAs, including equity assets and real estate and everything, is more than $60,000. So even if the investor is not in US, even if the inheritors are not in US, estate tax will become applicable if there is a transmission of securities involved.
Okay. And the second question is, what are the offering of Parag Parekh in Gift City? You have not covered that.
So what we have at present in terms of Parapare's Gift City offerings, the first one that we launched was a PMS, outbound PMS. After that, in the month of March, we came out with the twin NFO for our two passive funds, investing in S&P 500 and Nasdaq 100 respectively. So both of those funds are retail in nature and with a lower ticket size of around $5,000 for initial investment and then $500 for subsequent investments. What we also have in pipeline is a couple of outbound funds at present, which will come over the next quarter or so. A couple of inbound ones, sorry. Both of them are feeder funds, feeding into flexi cap fund in India and the large cap fund in India.
Thank you.
So, presentation is very nice, and I had been to the Parag Parekh presentation on the funds that was given by probably your colleagues. My question is currently, as you said, SIP is not available, and 5,000 USD is like not covering the large number of people. So, do you expect this ticket size to come down?
Yes. So the ticket size will come down over a period of time. Now, see, how much effort do you put in for investing what amount, and how much cost do you incur for investing that amount? Those are two parameters to consider. So if you are investing, if you have to go to a bank branch to transfer this money, let's say that is what happens if you don't have a one of the private sector banks which allow for online transfer. And if you're going have to go to that bank branch and basically uh, educate the branch manager on what LRS is and how to do a LRS transfer. Do you do it for a 50,000 rupees transaction, or do you do it for a 5 lakh rupee transaction? That is one. Second is, what cost does it incur? So the cost, what we have seen is the forex plus the fees that is involved can be, it can be as low as 1,500 rupees. It can be as high as more than 5,000 rupees. Now, doing that kind of expense for a 50,000 transaction or versus a 5 lakh rupee transaction, those are the parameters that one would consider. And largely, if we are able to give a very seamless journey where people can keep doing these transactions digitally, that is what we are looking for. And that would be a point to where we would want to, or any fund would want to consider reducing the ticket sizes.
So this is not a regulatory requirement.
There is a regulatory minimum.
Okay.
As such is like.
So recently, in that presentation only, I think I was told that you have tied up with couple of banks who are giving currency conversion at a particular rate. Where if any investor wants to put money in Parag Parekh fund, then a special rate is offered.
Yeah, so typically the forex spreads that banks charge any client, there's obviously a rack rate which can be as high as 1.5 to 2% above the interbank rate. And then there are rates, preferential rates, which are available to clients depending on their own relationship with the bank. And obviously, the rates for retail versus the rates for businesses are very different. Now, because we were bringing in a retail product, but we had some volumes to cater to, that allowed us to go and negotiate with a few banks, and some of them did agree to give a preferential rate. So ultimately, that helps the investors, and that reduces the cost that I talked about of 1,500 to 5,000. So yes.
So what is the overall growth you are looking at in GIFT City funds?
Sir, it is my
Not
duty to
about
be very
Bharat.
optimistic
No, not about Bharat only, but
in general, because that is where I work. But keeping the optimism aside, what we have seen in the last, I've been there in the ecosystem for 3 years, more than 3 years now. You've been there for what, more similar time period. Probably had you asked this question 3 years back of what is happening in GIFT City, how is it progressing, versus what my answer would be today, there would be significant difference, because we have seen initially when I used to go to GIFT City, there was hardly any activity. I mean, there were a few KPOs there. There were a few. There was some activity around taxation, or some activity around this other things, but fund management was at a very nascent stage, and nobody had really thought about doing a retail fund then. But in the last 3 years, things have evolved a lot. People are now not getting space for setting up their offices. Obviously, space will come by, but that also shows the kind of interest that investors have had. People have had in setting up entities. Investors have also come in leaps and bounds. So, a data point, this is uh, from the September IFSC bulletin that came out. This was right after the first retail fund was launched. So, I showed that 200 odd fund entities and 313 odd funds that are there. But in terms of number of investors, it was only somewhere less than 6,000, less than 20 investors per fund. Right now, the retail fund ecosystem in itself would have probably 6,000 investors. Or if it is not there yet, it will reach there in a few months' time. In our NFO, we were able to open folios for more than 1,000 people or so. So the activity has grown leaps and bounds, and it is growing in both the direction, not just outbound but also inbound. So I do see a very successful track for GIFT City over the period.
There is a huge pipeline of various retail products which people are trying to launch from the GIFT City. So people are trying to make the global investing or the inbound outbound options more accessible to the retail people, and that's why we are seeing a lot of retail funds coming up nowadays by various EMCs.
okay, thank you.
So we have one question online. When are you all expected to get the global active fund? So actually the short-term capital gains for a fund is quite high, and I mean the fund has to pay the short-term capital gains tax at 42.744, which makes the churn in the fund very costly. So we are trying to figure out the tax efficient mechanism for that, and once we are near to that, we'll maybe roll out the active fund as well.
Really nice presentation. So I think Nirmal, on your point, I couldn't understand like a small point on the bank transfer. So let's say someone has RSUs or ESOPs in the US, and due to some reason they want to bring back the money, right? So they sell the US stocks. But if the US bank account is not allowing transfer to GIFT City, then how will they bring that money to a GIFT City fund? So that is the first question. Also, I have that. Okay.
It is not that it is not allowing. It is that at present it is not seamless. You'll have to talk with that bank. You'll have to talk with the Indian bank and then facilitate that transaction, because it has those specific requirements, and each jurisdiction, each bank will have something of that sort till the time GIFT City and IFSC itself becomes a very well known jurisdiction in itself. Yeah, sorry, you had a second question.
And lot of the people having assets in US, they just want to transfer the asset to avoid the estate taxation. But after bringing the money to, like, let's say GIFT City or something, they don't immediately want to invest due to war or something. So can they transfer the money to GIFT City but not invest in a active equity product directly? Or like, are there any liquid fund alternatives, or like how can people do that?
I think at present there are very few liquid fund alternatives or something. There are a few AIFs which offer such liquid funds for sure. The ticket size there remains a constraint because it will be a minimum $150,000 unless someone is also accepting accredited investors. But otherwise, the banking system will for sure not accept that funds unless you've taken that money through LRS in the past and you can show that to the bank. But such options will gradually come up. This again, the good thing with this is that the solutions are coming up, and once people figure out what the problems are and that investors are facing, there would be products which will come in corresponding to those problems. Okay. If there are no more questions,
Thank you.
thank you.
Thanks.
This initiative is undertaken solely with the objective of educating people at large about financial concepts, sectoral knowledge, and related matters. It is intended only for general awareness and learning purposes and should not be construed as advice, recommendation, or solicitation to buy, sell, or hold any securities or financial instruments. The information and views expressed are based on current understanding and are subject to change over time with evolving market conditions, regulatory developments, and other factors. The presenter or the company they are associated with may have existing exposure or professional knowledge relating to the sectors, themes, or concepts discussed. This does not, however, constitute a recommendation or endorsement. Participants and readers are strongly encouraged to exercise their own judgment and seek professional guidance before making any financial or related decisions. This initiative should be viewed purely from an educational perspective and nothing else.